what I'd like to talk a little bit about is your option strategies,
Mhm.
because one of the things that's kind of nice about when you're on the show on IBD Live, and when you're kind of discussing your strategies, is that you don't necessarily need a raging bull market, and you don't need huge destruction of a bear market that is like even like something like 2022, where it was just persistently ugly for growth for quite a while. You can really kind of find find nuggets in any type of market. So describe a little bit about what it is that you do
Yeah.
to do
So
that.
first off, I'm still using the growth, canceling principles to find stock trades, and then I like to apply options to something that I find that looks bullish. Primarily, I'm on the long side looking for moves to the upside, but I'm looking for something that's got some liquidity. It's got really good liquidity. I then once I determine it's got the nice liquidity, then I'm going to go to the option chain and I want to see what the bid ask is to see, okay, do we have wide spreads? Are they pretty tight? And that's something I would be looking to put together an option trade on.
Hmm. And you do a lot of spread trades. So,
Yeah.
you know, uh, kind of describe. There's two types of spread trades, at least vertical spreads that we typically talk about. There's the credit spreads, and then there's the debit spreads.
Mm.
And then of course you can have the bullish ones and the bearish ones. So
Yeah.
how do you kind of decide which one you're going to use in what situation?
Well, I like the credit spreads because if during when you're putting together a credit spread, your break even is typically below where the stock price is. And a lot of your debit spreads, that break even can be above the stock price. So that stock would have to make a move, or ETF will have to make a move to the upside before you can even consider that you're at the break even. I like it when it's down below the stock price. So that way, if the stock does, maybe it breaks out a little bit and it declines a little bit, well, I'm still in good shape because I
Mhm.
haven't gotten down to my break even. So that's primarily why I like to sell premium, because of that break even. It's typically, in most cases, it's going to be below the stock price, so you have a lot of wiggle room for that stock to move around in.
Let's talk about GLD. Why GLD? What was the pattern or the technical action that was intriguing for you?
Yeah, so you look at it technically, it's above the 21 day exponential, it's above the 50-day, whereas a lot of the indexes and a lot of your big names like the Max 7 are below those those levels, those
Mhm.
moving averages. So it's showing what we call relative strength, and that's what you always want to look for in a market that we're in. You want to see something that's showing some relative strength versus the overall market. In addition to that, it's gold. So with the volatility that we've seen in the market, gold tends to be, and historically has been a place where, okay, I can park some money in gold because it's a place where it in the past hasn't moved so much in the past. So it's a good place where you can park some time of money in times of uncertainty. So you look at the setup and the well, historically what it's been used for. That was my attraction to this trade here. And
Mhm.
if you look at the chart, also, I always key in on that 21-day exponential. That's that green line on the chart, and you see that's above that 21 day. So when I was looking at
You mean
this
above the 50
ETF,
day?
what was that?
So you look at the 21 day. You said above the 21 day, or
It
you?
was above the 21 day. It's also above the 50 day, but I was
Okay.
keying in more on the 21 day because you see it's been finding support up that
Okay.
21 day. You see that for the last week, and if you keep going a little bit to the left, in early August, it found support back then. So that 21 day has been a key support level for this ETF. So just looking at that, so when I was looking to put together this trade, one of the things you can do with market surge is if you hold your left mouse button down on the price, it'll tell you the value of the moving average. So this morning before the market opened, that's what I was doing. So I held my left mouse button down on which would have been yesterday's price bar, and I saw it. Okay, the 21-day exponential is right around 230. So I could, okay, well, let me use that'll be my short strike. So if it does pull back to that 230 level, If I sell a put, selling a put is a bullish option trade. So if I sell a put, if it comes down to the 21 day, it gets support, then then that bullish part of the trade will start working there. So I
Mhm.
looked at that, and then I like to use spreads. Spread trading, you're not going to hit big home runs. I like to, using a baseball analogy, uh, uh, spreads is, you're going to get a lot of singles and doubles. So I
Mhm.
like to use that, and I just like to put on a lot of trades so I can make my, get my equity curve to move to the upside there. So I saw that 230 was was what the 21-day exponential moving average was. So I went into my trading platform. I saw, okay, where is 230? Okay, 230 was a nice place. So I went to um, put my short strike there. So I sold the 230 put, and then I
Mhm.
went up to the 225. I bought that for protection. So that's how you structure a spread trade. And at the time, I believe the credit was for $1.56 or something like that. And
Mhm.
so, and I was looking at it, about a half hour before the market closed. It was still the stock, their ETF, it didn't move much today. So, if you still want to use that trade, you can still use the same strikes, selling to 230 put, and then buying the 225 for protection.
Mhm. So what ends up happening again, and this is one of the things that's kind of nice about spread trades is, normally when you short a put, you have to have cash, available to buy the stock in case you're assigned. But in this case, because as you said, you've got that 225 as protection. It basically once you get down that far, you're going to start making money on your 225 long put. That's going to kind of cancel out any money that you're losing on your short put. So
All right.
you don't
All right.
have to have all that cash readily available for potential assignment.
All right.
Um, so,
And as I mentioned earlier about the break even being below the stock price, in
mhm,
this case, selling that 230, buying the 225, the break even was right around 228, which
yeah,
was a
probably
little bit
two twenty
below.
fifty.
Yeah, what's a little
Hmm.
bit below that 21-day exponential moving average. So
Hmm.
there's where that wiggle room comes into play. Where, okay, if it pulls back, you're still in good shape.
Hmm. And it also looks like it's kind of 228.52 was this level that it kind of got the support at the 21-day moving average line last. So,
Mm,
yeah, a logical area that your
yeah,
break even is. So,
right, right.
so in terms of kind of a stop loss, do you look at your option trade or do you look at the stock price
I
as
look at the stock price.
okay?
So I look at stock price and see, okay, where is the stock trading? So for example, I had a spread trade in Netflix.
Hmm.
Netflix today was trading below the 21-day exponential. Now it did recover. This was earlier in the day, so of course I sold it. And what did the market do? It turned around. But at the
Hmm.
time, it was trading down below the 21-day. The market was really weak, so I said I'm just going to get out of it. I was already down in the trade. I already had a loss in it. But uh, bottom line is, like, my point is, I was using the moving averages and support and resistance to determine when I'm going to sell the stock rather than the option itself.